Hi, this is Kyle Ferguson with OptionsSherpa.com. And on this Sherpa cast, I'm going to go through the covered call calculator on the Alpine Advisor. And the reason that we have this covered call calculator is for our subscribers to kind of get a visual picture of how this strategy works and why we do it the way that we do it. Now, we are much more aggressive with our covered calls than most investors are. And by using this calculator, you'll kind of see why. I'll kind of walk you through the different steps that I look at to choose these trades and why I chose to go with this particular strategy. But the other thing that we have the calculator up there for is that we want subscribers to be able to analyze their own stocks. Not every subscriber has every Sherpa stock. They have different stocks in their portfolio, and it's important to us that you know how to do this strategy on your own. We don't want you guys just copying us every single week. If you want to do that, you're more than welcome to, but if you want to put a covered call on a different stock in your portfolio that we might not have, we want you to be able to do that. So that's kind of the reason that we put these different calculators on there. So let's get into it. The first thing you're going to do to pull this calculator up is you're going to go to the Basecamp tab up here, scroll down to Sherpa Tools, and that will bring up our 6 calculators. Now, we've had a few subscribers ask us, why do we have 6 calculators up here if we're only doing covered calls? Well, the reason is that, there's a lot of option strategies out there. We've traded a lot of option strategies. Our subscribers trade some different option strategies. So we just put it out there for you guys to kind of play with, to let you know, hey, there's different stuff out there. But by all means, the covered call calculator is the most important one to us. And if you're an Option Sherpa subscriber, it's the most important one to you. So that's the one you really want to focus on as you kind of get into doing these trades and following the Option Sherpa newsletter. So once you click on the covered call calculator over here, it'll bring up this page. And this page, just to kind of break it down a little bit, it's a tool used to see what your potential income and return will be on any particular trade. It will also show you how you will do if this, if the underlying stock drops 10% or goes up 10%. So it kind of gives you a range over the time period that you've chosen, whether it's 1 week, 1 month, or 1 year, how this trade will perform during that time period. So, it'll tell you basically the income that you can expect on the trade, the percent return that you can expect on the trade. If you got that return, over the same period all year long, what that would be, what your break-even point is, and then what your max profit on the trade is. So, for this example, I'll pick Barrick's Gold, which is in both our enhanced dividend and our focus income portfolios. And what I do is the first thing is you enter the ticker symbol of the stock that you want in there. So for Barrick's Gold, it's ABX. We go ahead and you would just enter this ticker symbol. You would go over here and enter the number of shares that you own of Barrick's Gold. In this case, I'm just going to use 100 for all the examples. But if you owned 500 shares, you could put that in there, and it would change all the calculations appropriately. 100 shares equals one contract covered call, so that stays the same. Go over here and press calculate. And after you press calculate, it auto-fills all of this down here for you. So the only thing you are really entering is the ticker symbol and the number of shares, and everything else will autofill so that you can see. Now, what's going to come up is it's going to auto-calculate what the current stock price is. So this is what Barrick's closed. It's a Thursday night. It's 20.98. The closest call strike to Barrick's, because we sell our calls really close to the money. So 21's obviously only 2 cents away. Now on here you see it's only 17 cents. Well, that's not great for us, even though it's still not too bad. That's not what we're looking at. So you want to make sure you're on the right expiration date. And over here you can change the expiration date to anything that the option chain currently has listed. So for the way that we trade, we're interested in February still, and we're interested in next Friday, which is the 28th. So go ahead and click on that, and you can see the first thing that happens is it changes the call price or the premium that we're going to receive, and then it auto fills and changes all these down below as well. So we're going to receive 45 cents for selling an at-the-money 21 call strike on ABX for next Friday. This calculator tells you that you're going to get $45 on the trade, which is nothing more than 45 cents times 100. It's going to tell you that you're going to return 2.14% on the trade if it goes nowhere. So that's basically if nothing really happens to this stock and it just goes up to its maximum, or it goes up to this point right here, you get 2.14. Annualize that over the number of days we have left till expiration, and it's 111.84%, which is a really important number, and I'm going to come back to a little bit. And that seems like just a crazy return, and it is, but you'll see what that means once I explain it a little bit. And really in that number is why the strategy works. So I'll come back to that. The break even is nothing more than the premium that you're taking in minus the current stock price. So as long as a stock stays above 20.53, you're going to make money, which in turn is, as long as it stays, it doesn't drop more than 2%, you'll make money on this trade. And then your max profit is $47. Well, the $47 is this $45 premium plus if you made 2 more cents up to this 21. So the best case scenario that could happen on this trade is that on next Friday, when this thing expires on February 28th, the best thing that could happen to you is it closed at 21. You would earn 100% of your premium, and you would earn this extra 2 cents. So this isn't that important because this is so close to the strike, but kind of on other trades, especially if you're doing monthly covered calls or more, that starts to add up and makes kind of a big difference. So the next part of the calculator is the risk management. And what this does is it's a what if calculator. So if the stock doesn't do anything, next Friday when this expires, it's at 20.98. It's a dead break even, which happens more often than you'd think. You would earn 2.14%. If it goes up 2.5% next week, you will earn 2.24%. If it goes up 10% next week, you will make 2.24%. Well, the reason that's being is because your upside is capped, and that's a lot of guys are down on covered calls because that's what they say. They say you're capping your upside. You're capping your upside. Well, you are. But with the premium that we're selling and with the time value or the theta that's left in this premium, it's giving us 2%. So it's also giving us protection of 2% on the downside, but we're taking in a 2%, income premium, which I kind of treat as a dividend, which is this 111% all year long. So if I'm taking in 111% of premium on a stock all year long, I can do a lot of things with that stock. It can drop a lot. And as long as I'm consistent, I have a lot of wiggle room to still make money on that stock. If it continues up, maybe it only goes up, 1%, then I still am going to get that premium out of it. So I'll get profit on the stock and I'll get profit on the option premium. And excuse me, as we go through these different calculators and we do these different Sherpa casts and stuff, you'll really you'll have an aha moment of why selling so close to the money week after week works. It's a huge advantage for us to be able to take in a 2% premium every single week. And it's no coincidence that Barrick's Gold has a 2% premium. That's the kind of stocks we're looking for. We're looking for stocks that have good growth potential, good dividends, and then this great premium. So on the flip side of that, we're looking at the downside protection. Now, we took in 2.14%. So if this stock drops 2.5% just next week, then we'll only lose 0.36%. And if it drops 5%, we'll only lose 2.86%. So that's also the advantage in this strategy. I mean, you have to realize how big a 5% move is in the next 7 or 8 days, and how big a 5% move on the upside is in the next 7 or 8 days. It doesn't happen that often. If it happens, it's usually around earnings season or something drastic in the overall market. But we'll take those hits when that happens. If it goes up 5%, we're still going to make 2.24, and if it goes down 5%, we're only going to lose 2.86. So we're going to lose half of what the market's lost. So we want to do this every single week, and that's the discipline and the consistency is why this strategy works. So that's just kind of an overview of these different percentages. It also gives you what the stock price would be if it dropped 10% or any of these percents, what the loss would be on the stock, what the value of the call would be at expiration, and then what the profit and loss on the call option would be, your total net profit and loss, and then the percent, of course, return on the trade. So that's a quick run through. Let's do another example. Let's do let's do healthcare. Let's do XLV out of our diversified ETF portfolio. So we're going to type in XLV, our ticker. We'll keep it at 100 shares and press calculate. Now, again, the first thing I'm going to do, it depends on when you're doing this calculation. When I'm doing it, I play with this thing a lot on Friday mornings before I send you guys the trades out. So this is always the right expiration, typically. But if it's not, you got to bump it up here. So just change that. Make sure you're on the right expiration. You'll go February 14th. It's February 2014, the 28th. This is our call price. The closest strike is, this one's only 8 cents away too, so the 59. The return for just this trade is 75 cents. Annualized return is 38.94. Now, I want to point that out to you, and we've kind of talked about this a lot, is the diversified ETF portfolio in the Option Sherpa has much less volatility than the other portfolios. And you can tell by looking at this right here is 38%. If you give me a 38% return on a stock, that's a great return, cash on cash return. But you noticed when we had Barrick's Gold, it was 111% return. And that just has to do with Barrick's Gold is going to move a lot more than XLV is. So the option premium is going to pay you more. So as you go through these portfolios and play with these calculations, you might throw one in there, maybe on Johnson & Johnson, and you're going to be like, oh, this is only, giving me, maybe a 0.2 premium, which annualizes out to 24%, and that bums you out. Well, Johnson & Johnson is an extremely low volatile stock. So you compare Johnson & Johnson to something like Tesla or Facebook or a high-flying tech stock, you're going to get a lot less premium, and the annualized return is going to be a lot less. So we try and balance consistent stocks with stocks that have good potential growth rate and a little higher premium to get a good balance across all the portfolios. So I just kind of wanted to point out why that was 38.94 and the previous one was 111. So it gives you our break-even point and our max profit. It drops down here to the different risk managements. I can tell you that, for XLV to move 2.5%, that is just a huge week. And then for it to drop 2.5%, that's a big week. So it gives you an idea. Usually, these things, we can look at what the average true range or trading level is for any of these stocks too. But it gives you an idea of how these stocks make money and why it works if you continuously do it week after week. I'm going to throw another one up here out of the focused income portfolio, which is, this one has been, Facebook is just, we've made a killing on it so far this year, and it's continuing to go up. So we're going to hold it for now, but you put in Facebook 100 shares, press calculate, and it populates everything. Everything is good to go. I'm going to just jump down here real quick and make sure it's on the date that I want. So actually what I'm going to do right here is, I've done all these on a weekly basis. I'm going to show you. Let's jump out. Most people trade covered calls on a monthly basis. So March 22nd is actually when the March monthlies expire. So if someone's going to sell a covered call, they're going to probably do it not at the money. They're probably going to do maybe around 5 to 10% out of the money, which would be 75 would be almost 10% out of the money. And I used to do that, and I still do that on some of our clients' portfolios. But you can see that the current stock price of Facebook is at $69.63. 75 call strike is, almost 6 points out, so maybe 8% out of the money. And then it's giving you a 1.34% premium for, approximately 30 days away. So look at that. You have 100 shares. You're making $134, which is 1.92%, which is 24% annualized. So if I do this 12 times a year, I'm going to get a 24% return if I can get a similar call strike to this, and I can achieve all of my option premium. Well, one thing that by doing this strategy is I give myself a little more leg room to let this thing run up to 75. Will it? I don't know. Personally, I mean, Facebook is just on a huge run right now, so I would personally be looking to sell them a little tighter. But this is the way that guys sell covered calls. The general public, when they hear covered calls, they're going to sell them further out of the money, 75s instead of the, what would we get for the 70s? See, we'd get a $3 return, which would be a 55% annual return. So just by going at the money, we more than double our annualized return. And yes, we don't get this 69 to 75. We only get 69 to 70, but we're making up for that somewhat on the premium that we are receiving. So you can see, that's kind of an example on the monthly basis, of what you can get by doing this 12 times a year, and there is nothing wrong with that. I think that's fine if you guys want to do that. A lot of guys can't do this every Friday, and that's a perfectly legitimate strategy to do. I just choose to go every week. So if you can kind of remember these numbers, and I'll jump back to February and throw in next week's strike price, I'm getting $1.53. Now, $1.53 for the 70s at the money. If I did the at the money calls on the monthlies, I was going to get around a 50% return. Well, if I do them at the weeklies, I'm going to get about a 114% return. So you can see that the discipline and the consistency of doing this every Friday, week after week, is you're going to increase your chances of getting a good premium, a good return, way more than you are if you do it on a monthly basis. Like I said, nothing wrong with the monthly basis, but if you can do it on a weekly, it will really pay off because of the compounding will start to kick in. So that's kind of an example of, Facebook has a little bit higher premiums than most. We could do just real quick, one that has maybe some lowers. We throw that in there. It's still, all these are so close to the strike that we're getting such a great premium. There it goes. I'm sorry. So that one, this one, Mo is actually maybe a little bit more realistic for some good dividend paying, less volatile stocks. 27% return, $19 every week. So, roughly $76 a month on 100 shares. So $76 a month on roughly a $3,600 investment. That's pretty good. I'll do a Sherpa cast on comparing owning a rental to doing covered calls, and you'll probably never buy a rental again. But that's basically it. This kind of gives you an idea. Play with this calculator. Look at the risk management. If the stock jumps up 5% or if it drops 5%, it'll give you the different returns. And you can, play with these numbers a little bit. Throw some of the stocks and ETFs in your own portfolio. Check the ones that we're putting out there. Put them in the income portfolio. See what you can return on them with the current premium. You can always check us using this stuff. That doesn't phase us at all. So go ahead and do that, and always email me. Go to optionsherpa.com and email me any questions, and I'd be happy to answer them. So that's it. Have a great day.